Silver's spot price is screaming bloody murder today, tanking around $74.50 to $74.80 per ounce. That's a brutal 2 to 3% nosedive just in today's session alone. Straight down from yesterday's $76.50 close.og. Jhone AG here. Now, if you're actually learning something here, if you're verifying the data and it's sharpening your view, comment OG Jhone AG below. And get this, we're in the middle of a 3-week massacre, with silver plunging over 20% from those insane late January highs above $121 an ounce. That's right, over $46 wiped out per ounce in less than a month. If you were holding 1,000 ounces, that's a gut punch loss of $46,000. Shocking, isn't it? But hold on, because as the king of COMEX insights, I'm about to break this down like never before, decoding the futures frenzy, the holiday hangover that's amplifying every move, and why this volatility could be your golden, or should I say silver, opportunity. Stick around, because we're diving deep into the numbers that have traders sweating, and I'll give you my unfiltered take on whether to buy this dip or brace for a deeper crash to $70 or even $68. Let's get into it. First off, let's paint the picture of today's bloodbath. COMEX February 2026 futures are hovering at about $74.75, with a tiny open interest of just 218 contracts. That's minuscule activity, folks, but it's telling a story of exhaustion after the wild ride. Flip over to March 2026, the real front-month beast, and we're looking at 58,770 contracts outstanding, equivalent to a staggering 293.85 million ounces. That's enough silver to fill warehouses, but here's the shocker. With registered inventory sitting at a razor-thin 92.9 to 100 million ounces, the coverage ratio is a dismal 13.9% to 15% for total open interest across all months. Break it down further. For March alone, it's only 31 to 34% covered. Imagine that. If even 15 to 25% of those contracts stand for delivery, we're talking 44 to 73 million ounces getting yanked out of vaults. That's more than half the deliverable stock. No wonder the market's on edge. We've seen record deliveries already, like 49.4 million ounces in January and 19 million in early February, up 4 times year over year. This isn't just a dip, it's a potential powder keg for a squeeze that could rocket prices back up. But why the hell is this happening right now? Blame the Lunar New Year ghost town in Asia. China and Hong Kong markets are shut down, leaving us with paper-thin liquidity. Volumes today? A pathetic 33,556 to 34,851 contracts traded. That's like trading in a vacuum, where every sell order echoes like thunder, exaggerating moves by 2-3 times normal. Add in a stronger USD, delays on Fed rate cuts, and profit-taking after that 7 Sigma rally in January. Yeah, you heard that right, 7 Sigma, meaning a statistical anomaly so rare it's like winning the lottery twice. Speculators got YOLO fever piling in during the parabola, but now margins are hiking and weak hands are folding. Total open interest across all silver contracts down to 133,641, a 6.66% drop week over week from 143,180, and a whopping 21.72% plunge year over year from 170,726. That's 9,539 contracts vaporized in a weak speculative liquidation at its finest. The CFTC Commitments of Traders report from February 10th spills the beans. Non-commercial longs down 2,223 to 36,660. Shorts up 699 to 13,705. And spreads slashed by 6,737 to 29,843. Net speculative position? A cautious 23,000 net long, signaling everyone's hitting the brakes after the froth. Now, let's zoom out for some year-over-year perspective to keep you grounded. Silver's still up a mind-blowing 126% from last year. So this correction? It's healthy, but it's hurting. Inventory is depleting at 11.73% monthly, with daily withdrawals around 785,000 ounces. Eligible stocks are there at 376.4 million total, but they can't settle futures without jumping through hoops. That's why registered is the real bottleneck. Analysts are whispering dangerously thin coverage. And with first notice day for March looming on February 26th, just 9 to 10 trading days away, this could turn into a full-blown paper crisis. I've seen this before. Industries like Tesla and Samsung are rumored to be bypassing COMEX altogether, snagging direct deals from miners at 20% premiums. That's real-world demand clashing with futures fiction, and it's got bears and bulls at each other's throats. Speaking of which, let's pit the bulls against the bears in this epic showdown. On the bull side, fundamentals are roaring louder than ever. We're staring down a projected 67 million ounce deficit for 2026. That's the 6th straight year of shortages, folks. Industrial demand from solar panels, EVs, and AI is exploding, offsetting any weakness in jewelry. JP Morgan's calling for an $81 average price this year, and physical premiums in India and Shanghai are holding firm, signaling buyers are scooping up dips. Investment flows, steady as she goes, with ETFs and bars flying off shelves. Ratio watchers are buzzing too. Gold-silver ratio could compress to 30, catapulting silver to $250 if gold holds steady. Influencers like Robert Kiyosaki are hyping crash prep, but stacking silver on the cheap, saying this is the dip to dominate. In post-holidays, when Asia reopens, expect a demand tsunami. China's back online soon, and that'll flip the script on this thin trading nonsense. But the bears? They're not sleeping on this. They're screaming thrifting and solar. If prices stay low, manufacturers cut back, destroying demand below $73. Potential tests of $70.73 support loom, and if that cracks, we're eyeballing $68.54, a 10 to 25% further freefall. That's another $6.20 per ounce gone, wiping out billions in market cap. Low volumes mean one big seller could trigger a cascade, and with leveraged unwinds from the January exhaustion, it's like a house of cards. X is lit up with chatter, threads calling this a holiday hangover correction, with users posting roller coaster charts, silver from $76 plus to $74, down to $73, back to $75, all in a day. One thread nailed it. Tuesday morning in silver, China on holiday. NYC closed yesterday. Pure volatility. Bears are piling on, warning of sub $70 by year-end if deficits don't materialize as hyped. And don't forget the macro headwinds, a stubborn Fed, geopolitical easing like US-Iran talks and Ukraine-Russia progress, reducing safe haven bids. Now, shifting gears to gold, because these metals are twins in this storm. Gold spot and futures at $4,930, $4,950 per ounce, down 1.5-2% today on the same thin liquidity and USD strength. But gold's correction is milder, just 11 to 12% off January's $5, 600 plus highs, with year-over-year gains at 68 to 72%. Open interest? More stable at 404,391 contracts, down a modest 1.29% week over week from 409,694, and 25.39% year over year from 542,004. That's 40.44 million ounces equivalent coverage at 43 to 51% with 18 million ounces registered. Not as critically thin as silver. CFTC shows net speculative longs moderating, but commercials are upping longs defensively. No March delivery crunch here. April's the focus with low February residuals. Gold's unwind is a breather, not a panic. Volumes 80,000 to 89,000 today, and inventory at 17.58 million registered. Down but manageable. Bulls see consolidation before new highs, fueled by central bank buying and ETFs. Bears eye $4,800, $4,900 if USD rallies. Compared to silver, gold's less squeezy, more steady bull. But if silver's ratio play hits, it could drag gold along, or vice versa. X options bets on $15, 000 plus gold calls show diehards aren't quitting. And let's not ignore the silver miners. They're getting hammered in pre-market down as silver slides. Think about it, companies like Pan American Silver or First Majestic, their stocks are proxies for the metal, and with spot at $74, margins are squeezing if costs are $20.30 per ounce. A 2% metal drop translates to 5 to 10% stock plunges easily, especially with operational risks in volatile times. If this correction deepens, miners could see 15 to 20% haircuts, but on the flip, a rebound to $80.90 boosts them 30% plus. Deep analysis here. Miners' all-in sustaining costs averaged $18.22 last year, so at $74 they're printing money, but investor sentiment's fickle, tying to futures more than fundamentals. Watch for earnings reports. If deficits hold, miners rally hard. What should you watch next? Key levels. Silver support at $73. Break that and $70 is in play. Resistance at $79 for a bounce. Post-holiday Asia reopen could spark buying, but COMEX March risks deliveries spiking. Inventory below 90 million ounces. Red alert for squeeze. For gold, $4,879 support, $5,000 resistance. OI above 410,000 signal strength. My take as OG Jhone AG. This feels like a classic shakeout, flushing weak hands before the bull resumes. Fundamentals scream by 67 million ounce deficit, industrial boom, but respect the tape. If you're long-term, stack on dips, but hedge if $73 cracks. Shocking stat, silver's YTD volatility is 50% higher than gold's, making it the wild child for traders, with silver spot clinging to that $74.50 finest $74.80 range after a brutal 2 to 3% tumble today, and a gut-wrenching 20% slide from those January peaks over $121 an ounce. The big question on everyone's mind is, how are the silver miners holding up? Are their earnings about to explode like a supernova, or is this market correction about to expose some ugly cracks? I've crunched the numbers, dissected the reports, and I'm here to deliver a deep, no-holds-barred analysis that'll keep you glued to your screen. We're talking record-breaking revenues in the billions, shocking margin expansions that could hit 150% if silver rebounds to $90, and why this volatility is screaming opportunity for savvy investors, but also flashing red flags if the pullback deepens. Buckle up, because we're breaking down the giants like Pan American Silver, First Majestic, Hecla, and more with big numbers that'll make your head spin. Let's unleash this earnings tsunami. First off, let's set the stage with the macro madness. Silver's wild ride in 2025 and early 2026 has been a boon for miners. Average Q4 2025 spot was around $55.87, up massively from prior quarters, but today's $74 dip is testing nerves. Remember, miners are leveraged plays. A 10% silver price swing can amplify earnings by 30 to 50% or more, thanks to fixed costs. If silver stabilizes here or bounces back, fueled by that 67 million ounce deficit projection for 2026, exploding industrial demand from solar, up 20 to 50% yo-yo-y, EVs, and AI chips, profits could skyrocket. But if we crack $73 support and plunge to $70 or $68 as bears are howling on X, margins get squeezed and stocks could tank 15 to 25%. Shocking alert, in 2025, top silver miners already saw margins balloon from 28% in 2024 to 45%, with analysts projecting 150% at $90 per ounce. That's not just growth, that's a profit explosion wiping out years of underperformance. Invest.com. Imagine, at $74, all-in sustaining costs, AIC, averaging $18.22 per ounce, mean gross profits of $52.56 per ounce, multiply by millions of ounces produced, and we're talking billions in free cash flow. But thin holiday liquidity from Lunar New Year is exaggerating drops, and with COMEX inventories at a precarious 92.9 million ounces, any delivery spike could flip this script overnight. Now, let's zoom in on the heavy hitters, starting with Pan American Silver, PAS, the beast that's been crushing it. In full year 2024, they shattered records with $2.8 billion in revenue, up massively from prior years, net earnings of $112.7 million, 31 cents EPS, and adjusted earnings of $286.7 million, 79 cents EPS. PanAmericanSilver.com. Q4 2024 alone, $815.1 million revenue, $107.8 million net earnings, 30 cents EPS. That's record free cash flow of $196.2 million in the quarter and $445.1 million annually. PanAmericanSilver.com. Fast forward to Q2 2025, net earnings hit a staggering $189.6 million, 52 cents EPS, revenue $811.9 million, with silver output at 5.1 million ounces and gold at 178,700 ounces. InvestingNews.com. Why the surge? Strong metal prices, expanded margins, and their ESG-focused sustainable ops in Latin America is commanding premium valuations, outpacing peers by 20%. Invest.com. Deep dive, Pan American's AIC dropped to around $20/Oz in 2025, so at today's $74, they're minting $54/Oz profit. If silver rebounds to $80.90 post-holidays, Q1 2026 earnings could top $250 million, a 30% jump QOQ. But concern, if USD strengthens further on Fed delays, their export-heavy model takes a hit. My take? This is a dip buy powerhouse, but watch for delivery risks in March. COMEX. Shifting to First Majestic Silver, AG, the pure play thrill ride. On 2024 revenue, $242.2 million, but EBITDA only $23.9 million, highlighting cost pressures early on. LinkedIn.com, then boom, Q2 2025, record revenue of $85.3 million, up 46% yo-yo-y, silver equivalent production soaring 48% to 7.9 million ounces, including 3.7 million silver ounces, at realized prices of $32.95, investingnews.com. Margins? Hit 45% in 2025, up from low teens, thanks to strategic cuts and optimization. Invest.com. Shocking stat, at $74 silver, their low AIC, $18.20, translates to $54.56/Oz margins on 15-20 million annual ounces. That's potential $800 $1 billion in gross profit, if scaled. But X-Chatter warns, with silver's volatility 50% higher than gold, a deeper correction could slash Q4 2025 earnings by 20 to 30%. Earnings this week? Expect upside surprises, as Q4 2025 silver averaged 41% higher than Q3. Engaging twist. First Majestic's Mexican ops are bypassing COMEX rumors, locking in premiums, could add 10 to 15% to bottom line. Hecla Mining, HL, the veteran that's hitting records across the board. H1 2024. Top revenue at $435.2 million. EBITDA at $160.8 million. LinkedIn.com. Q2 2025 quarterly revenue $304 million, up 16% QOQ. Net income $57.6 million, 9 cents EPS. Adjusted EBITDA $132.5 million, and record free cash flow. InvestingNews.com. They've led silver miners over 5 months, but recent weakness, down while silver's up, stems from selling Canadian gold assets for a silver pivot. Big number alert, at $74. Hecla's 10-12 million ounce production could yield $500, $600 million in profits, but if support breaks, stocks drop 15%. Deep analysis, their EBITDA margin above peer average, 38.8%, positions them for outperformance, especially with silver's industrial tailwinds offsetting jewelry weakness. LinkedIn.com. Watch earnings, history of beating estimates, and with spot 38% above Q4 2025 average, Q4 could shock with $100+ million net. Dawn quote T sleep on MAG Silver. MAG the high margin darling. 2024 net earnings, $77.8 million, 75 cents EPS. Revenue from Municipio JV, $92.9 million. Adjusted EBITDA $186.7 million. YouTube.com H1 2024, revenue $44.4 million, but EBITDA $37.8 million, margin at 85.1%, crushing the 38.8% average. LinkedIn.com, tech upgrades boosted recoveries from 87% to 93%, and they're introducing dividends. YouTube.com, shocking, at $74, their low costs mean 200% plus margins possible, and with silver breakout potential, analysts see multi-bagger upside. SeekingAlpha.com, concern, smaller scale 18.6 million ounces JV, makes them volatile, but 2025 outlook positive with stabilized costs. Quick hits on others. Coeur Mining, CDE, Q2 2025, revenue $481 million, net $71 million, EBITDA $244 million, up 64% QOQ, free cash $146 million, fifth straight profitable quarter. InvestingNews.com, Santa Cruz Silver 2024 revenue $283 million, up 13%, net $165 million, EBITDA $53 million, up 200%. SantaCruzSilver.com, Aya Gold and Silver, IAYA, the pure play gem with 100% silver revenue, mining at $20/Oz cost, $70/Oz profit at $90 peaks, on track for 6 million ounces 2026, expanding 6x by 2030. Overall market, silver miners outperformed S&P by 15% in 2025, Silver ETF up 217%. Invest.com. But today's pre-market drops tie to silver's 2% slide roller coaster ahead. Wrapping this deep dive, silver miners' earnings are a leverage bomb. Deficits, demand boom, scream upside to $100+, but correction risks loom. Shocking projection. If ratio compresses to 30, silver hits $250. Miners explode 300 to 500%. My take? Earnings this week surprise up, but hedge below $73. If you're stacking miners, this dips your entry. Now we're cranking up the shock factor because the silver market is loaded with numbers that'll make your jaw drop and your portfolio decisions crystal clear. We've already broken down the COMEX chaos, the miner earnings explosions, and today's brutal dip to $74.50, $74.80. But hold on tight because these shocking stats are the real fireworks. We're talking multi-year deficits that could swallow entire annual mine output, inventory drains that scream physical squeeze incoming, explosive industrial demand from solar, EVs, and AI that's devouring supply, and historical extremes in the gold-silver ratio that have preceded monster rallies. If you're not paying attention now, you might miss the biggest wealth transfer in precious metals history. Let's unleash these mind-blowing facts and see why this correction could be the setup for the next parabolic surge. First shocker, the silver market is staring down its sixth straight year of structural supply deficit in 2026. That's right, 6 consecutive years where demand crushes supply like a freight train. The Silver Institute's latest preliminary estimate pegs the 2026 deficit at a hefty 67 million ounces, following a monster 95 million ounce shortfall in 2025. Zoom out further, the cumulative deficit from 2021 to 2025 alone is pushing over 800 million ounces. That's basically an entire year's worth of global mine production just vanished into thin air. Supply, total global silver supply is forecast to hit a decade high of 1.05 billion ounces in 2026, up a measly 1.5%, but demand stays rock steady, or even edges higher thanks to relentless investment flows offsetting any industrial or jewelry weakness. This isn't a blip, it's a structural crisis that's been building for years, and it's why prices have already rocketed 126% year over year despite today's pullback. Bears calling for sub $70? They ignore this math, deficits this persistent don't resolve quietly. Even more alarming, COMEX registered inventories have plunged below the critical 100 million ounce threshold, down to just 98.1 million ounces, after a single-day withdrawal of over 3.25 million ounces recently, with another 4.7 million yanked from eligible stocks in the same 24-hour window. That's a net drain of nearly 8 million ounces in one day. We've seen weeks where 33.45 million ounces disappeared in just 7 days, 26% of registered inventory gone in a flash. With March delivery looming and open interest still sticky at 58,770 contracts, 293 million ounces equivalent, even a modest 15 to 25% standing for delivery could wipe out half the deliverable stock. Physical premiums in Shanghai are trading $5.10 above Western spots, and rumors of big players like Tesla and Samsung snagging direct miner deals at 20% plus markups are everywhere. This is the classic paper versus physical disconnect. COMEX is bleeding, and when the squeeze hits, it could send prices screaming back to $90, $100 or beyond. Now, the industrial demand bomb. This is where it gets truly shocking. Silver's no longer just a precious metal. It's the backbone of the green and tech revolution. Industrial fabrication is projected at around 650 million ounces in 2026, a slight 2% dip due to thrifting in solar, but the growth drivers are insane. Solar photovoltaics alone have seen demand surge at 15-18.9% compound annual rates recently, with projections pushing solar to 20 to 30% of total consumption by 2030. EVs, demand exploding as battery electric vehicles overtake internal combustion by 2027, with automotive silver growing at 3.4% CAGR through 2031, and charging infrastructure adds even more. Then there's AI and data centers. These beasts are guzzling silver for semiconductors and high conductivity needs, with US and China data centers alone estimated at 350 million ounces in recent years, over half of annual mine supply. Overall industrial demand could surge 52% in some aggressive 2026 scenarios, from solar jumping to 213 million ounces, EVs to 140 million, and electronics/AI/5G to 235 million. That's not hype. That's irreplaceable tech demand in a world racing toward electrification and intelligence, and supply can't keep up because 75% of silver is a byproduct of other metals mining. Leverage alert for miners. Average all-in sustaining costs, AIC, hovered around $20.23 per ounce in recent years, forecast up to $23.44 in 2026, but at today's $74 spot, that's $50.54 gross margin per ounce. Run that to a rebound $90, and margins hit $65.70, a 1,200% cash flow explosion on a 240% metal move for the same cost base. Some low-cost ops, like certain Hecla quarters at $11.01 after byproducts, or Endeavor's Terranera projecting negative cash costs, mean profits go nuclear. Miners are leveraged 3-5x to silver price moves. That's why Payas, AG, HL, and MEG are positioned for multi-bagger earnings, if this deficit plays out. And the granddaddy shocker, the gold-silver ratio. Historically averaging around 53-61 long-term. Since 1915, it spiked above 101 in extremes like 2020 and early 2025, signaling silver was dirt cheap relative to gold. Those extremes preceded massive catch-ups. Silver exploded when the ratio compressed. Right now, after the rally, it's compressed but still elevated. If it reverts to historical norms like 30-41 in a full bull, with gold holding or rising, silver could blast to $150-250 plus. In past cycles, ratios dropped to 17, 1 in 1980 mania. Today's setup? Ratio watchers on X are buzzing. This could be the compression trade of the decade. These stats aren't just numbers, they're a wake-up call. Deficit stacking, inventories vanishing, tech demand unstoppable, miners printing cash, and ratio extreme screaming upside. Today's dip? A shakeout in thin holiday trading. The fundamentals? Bullish beyond belief.